Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. The S&P and the NASDAQ rising here, led by Alphabet after its antitrust ruling. And all eyes, of course, on the Fed with just a couple of weeks until a rate cut decision. We're going to dig into those big headlines impacting the market. Right now, there is just an hour to go until the closing bell, and stocks are looking mixed here with the popular averages. The Dow's down about 230 points. Your broad gauge, the S&P 500, is up about 0.1%. And your tech-heavy NASDAQ is up about 0.5%. Let's welcome in now our Fed correspondent, Jennifer Schonberger, and our markets and data editor, Jared Blickery, joining us to break down all the headlines. Jared, my friend, let's start with you on the trading action so far today.
Let's take a look at this mixed market here, and we'll start with the Dow down about 245 points or 0.5%. You can see it's just been kind of from the upper left to the lower right now, although we are off of those lows just a little bit. NASDAQ, kind of a different story. It's been in the green all day long, buoyed early on after the close yesterday. We got that Alphabet antitrust ruling on its browser, and here we have holding on to gains of about 0.5% for the NASDAQ. Then the S&P 500, almost flat now. It's giving up most of the gains that it had earlier in the day, but still positive. And I'll close here with the Russell 2000 in terms of the indices. That's also in the red, down about 1/3% off of its lows. I got to talk about the bond market here, which is wrapping up just as we speak at that 3 p.m. Cross threshold for the Eastern time. 13-week T-bill yield. I don't show this a lot of times. It's down 1 basis point today, but I want to show you the year-to-date because it has just been crashing over the last few weeks, and that has to do with expectations of a more dovish Fed. Lisa Cook plays into that, but also the labor market. We got another JOLTS reading this morning. Not that great in terms of the labor front. 10-year T-note yield, that is down 7 basis points today, and the 30-year, that is down 8 basis points. That is the biggest drop that we've seen since August 1st. So things are moving here. U.S. dollar index also down. And let me get to some heat maps and show you the sector action. If we have time for gold, I'll show you that too, because that is at another record high. But in sector action in the S&P 500, communication services, that is the home of Alphabet and also Meta. That is in the forefront, up 1.33%. Then you have consumer discretionary, home of Amazon and Tesla. That's also outperforming. And then tech, just barely in the green here. Energy taking it on the chin. Crude oil is down about 2.5%. So is XLE. And then industrials, materials, those cyclical sectors also underwater. And we take a look at the NASDAQ 100. That is a mixed board. You can see the outperformance from Alphabet and then the spillover into Apple from that browser antitrust ruling yesterday. So Apple up 3%. Tesla is in the positive for 1.75%. But Amazon, Nvidia, and Microsoft underwater right now. Meta just a little bit to the upside. And we'll take a look at the Dow and then hit a futures board. Apple again kind of stands out there, but you take the mega caps out of the equation. Walmart is a standout. That's up 1%. Chevron, again, that energy trade, that's down almost 3%. And not a lot of big outperformers or underperformers that we're looking at here. And as promised, here's this future board. Looks like platinum and palladium, each of those up 2%. But let's take a look at gold, up 1%. Here is the year-to-date, soaring above 3,600 to 3,628, and that is up 36% for the year. And then I'll show you crude oil. That was down about 2.5% today, just kind of trading sideways over the last few months. Not too much to read into that there, but fortunately, we have an energy expert on the panel today.
We sure do. And from markets to D.C., by the way, let's get to Jennifer, because, Jennifer, there's a lot of policy conversation today. The fate of the Fed is headed. What do we know about all that right now, Jen? What are you seeing?
Hey there, Josh. Yeah, a lot of Fed speak ahead of this Friday's all-important jobs report, and one hawk seemingly opening the door to a rate cut. St. Louis Fed President Alberto Musalem saying earlier today that he now sees higher downside risks to the job market and slightly lower risks to tariffs leading to hotter inflation, though he did not tip his hand for what he would do at the next policy meeting on September 17th. Musalem noting in terms of the job market that he is concerned about those large downward revisions that we saw during the month of July for the prior 2 months to the job market. He also noted that those who are unemployed are staying unemployed for longer. At the same time, he's less concerned about inflation, saying that he thinks the impact of tariffs on inflation are going to work their way through the economy in the next 2 to 3 quarters, and then we will see the effects fade. Meanwhile, Fed Governor Chris Waller reiterated that he wants to cut rates next policy meeting because he wants to stave off further deterioration in the job market. He wants to be proactive there. He told CNBC in an interview that he sees multiple cuts over the next 3 to 6 months, but that the pace of those cuts are going to be contingent on the incoming data. Meanwhile, Atlanta Fed President Raphael Bostic also says he's concerned about the impact of tariffs on inflation and keeping inflation expectations anchored, though he also noted that recent signs of cooling in the job market warrant a rate cut because if the job market were to turn, it would deteriorate quickly. Bostic writing in an essay earlier today, quote, "I believe that while price stability remains the primary concern, the labor market is slowing enough that some easing in policy, probably on the order of 25 basis points, will be appropriate over the remainder of this year." So, Josh, you have 3 members of the Fed turning their keys there for a rate cut. Back to you.
And Jennifer, while we have you, we're learning that Stephen Moran pledging to uphold Fed independence in his remarks, Jennifer, Thursday, while getting grilled by lawmakers at his nomination hearing on the Hill. What do we know about that?
That's right. Stephen Miron, who is President Trump's nominee to replace former Fed Governor Adriana Kugler, is set to testify in his confirmation hearing tomorrow morning before the Senate Banking Committee. In testimony that has been released this afternoon ahead of that hearing, Miron pledging to uphold central bank independence. He says, quote, "In my view, the most important job of the central bank is to prevent depressions and hyperinflations. Independence of monetary policy is a critical element for its success." He went on to say that the Federal Open Market Committee is an independent group with a monumental task, and I intend to preserve that independence and serve the American people to the best of my ability. Now, Miron also stressed that his opinions and decisions are going to be based solely on his outlook for the macroeconomic data and looking over the long term and what is best for the American economy. He said if confirmed, he will, quote, "transparently and honestly work toward what Congress has tasked the central bank with," which is, he says, pursuing price stability and maximum employment. And something that jumped out to me was, quote, "moderate long-term interest rates." We know that's not something that Congress has mandated the Fed to do. Fully expect to see Democrats hammering him on central bank independence, this theme likely to be front and center. So very interesting that he focused wholeheartedly on that in his opening testimony. Josh?
All right, all eyes on Capitol Hill. Jen, Jared, thank you. Appreciate it. Well, the Federal Reserve says U.S. economic activity saw little or no change across most of the country in recent weeks. It's from the Fed's Beige Book, a publication about current economic conditions across the 12 federal districts. It comes as job openings slipped in July, more evidence of some cooling across the labor market as the Fed weighs a rate cut later this month. And joining me now, we have Dennis Lockhart, former president of the Federal Reserve Bank of Atlanta. Dennis, always great to see you. So let's start there, Dennis, with some of the economic data and commentary we got. We did just this afternoon get the Beige Book, Dennis, and it's some interesting commentary there. Contacts, it says, reported flat to declining consumer spending for many households, it says. Wages failing to keep up with rising prices. That doesn't sound great. Combine that with the JOLTS job openings, Dennis, we got this morning. That came in below expectations. Add it up for us, Dennis. Your baseline expectations for the U.S. economy. What are you forecasting, Dennis, now and ahead?
Well, there's still a lot of uncertainty, and the tariff picture is an important part of that uncertainty. Clearly, the economy is slowing and the labor market is slowing. I think it's debatable whether what we're seeing in the labor market is a late cycle natural slowdown or something worse. And I think some of the FOMC members are now beginning to become more concerned that it's something worse, or it could be something worse shortly. And that's the reason we're hearing more voices consider a rate cut at the September meeting. So
the market, of course, then is expecting a cut at this meeting. Is that what you expect? And to your point about, we have economists come on, Dennis, and they say, listen, it's despite maybe their worries about inflation, the reason they'll argue that cut is a lock, they'll say, Dennis, is because the labor market is weakening, and when the labor market starts to weaken, things can go south quickly. Is that your take?
Well, the speed with which the labor market could deteriorate is really an important consideration. Having said that, I actually believe that this meeting will be more of a close call than the markets seem to have priced in. The inflation picture has not really improved, and it has deteriorated just a bit, particularly at the core level in the most recent reading. And they're still substantially above the 2% target. So it will depend a little bit on how the committee breaks between those who really want to prioritize inflation and inflation expectations, as Raphael Bostic said, or those who are really concerned that we're going to see a rapidly deteriorating labor side. I don't think it's a clear picture. I think there'll be voices on both sides.
On the tariff-induced inflation, Dennis, the big debate seems to be among our policymakers whether you think, listen, it's going to be transitory. It's going to be this kind of one-time price level shift, kind of like if you got a poor harvest. That seems to be where Waller is at. Or do you think, no, that's wrong, this could be actually more persistent? Where do you come down?
Well, I think you have to be cautious about coming to a conclusion on the transitory theme. The inflation picture could play out, not necessarily persistent, meaning 2 or 3 years, but persistent enough over several months that inflation expectations begin to shift and something a little bit more, let's just say a little bit more troublesome begins to develop. Logically, it should be a one-time event, but look at the way the tariff policy has actually been implemented. It's been on again, off again, lots of uncertainty as to what's going to actually happen. And now we have, of course, the court ruling that puts in doubt the overall picture on tariffs. So if I were a business person making decisions on pricing, I'd remain cautious and bide my time if I could, but begin to think about pushing those price increases through if tariffs stick.
I do have to ask you, while I have you, Dennis, about the ongoing Trump-Lisa Cook story. Bill Pulte saying he's going to have a press conference tomorrow morning on this. You saw Lisa Cook's legal team firing back, saying Trump doesn't have, valid reasons to fire her, deny these claims of mortgage fraud. What do you make of this story, Dennis?
It remains to play out, and it will play out apparently in the courts. I understand there's been one hearing, but no ruling. So we'll see what that ruling turns out to be, and then in all likelihood, there could be an appeal or a move to a higher court level. I think the really important question on the rate cut in September is whether Lisa Cook will be able to participate in that meeting, and whether Steve Myron will also be confirmed in time. You could have quite a different makeup of the governor's side of the room, depending on how that plays out. The Lisa Cook thing is going to be adjudicating what for cause means, and we'll see what the courts actually rule on that.
I want to get you on this, Dennis, because there are broader questions being raised, including on this program by different economists and strategists about Fed independence with all this. Former Treasury Secretary Larry Summers was talking on Bloomberg TV, and he said, here's what he said. He said, we're on the foothills of a credibility crisis. We are in completely unprecedented territory. You agree with that, Dennis?
I agree. We're in completely unprecedented territory. This has not been a one-time event, as we saw in history with Nixon or with conceivably Lyndon Johnson. This has been persistent now for many, many months and is unlikely to end, no matter how some of these questions around Cook and others play out. It appears to be an effort to put a bunch of allies on the board of governors. I think it's a serious matter. I happen to be one who believes that independence in formulating monetary policy is a fundamental of good governance in the country, and what we've seen has already done some damage to that, in my opinion.
Dennis, we always appreciate your time and your insight. Thank you, sir.
Thank you, Josh.
Markets are off to a bumpy start in September, which is historically, as we know, the worst trading month of the year. Investors are also looking ahead to the Fed September meeting, where markets are betting on rate cuts from the central bank. Here with ways to look through your portfolio is Lou Basenese, Prairie Operating Company, EVP Market Strategy, and the founder of thebigskinny.com. Lou, always good to see you.
Good to be here.
Let's just start with the trading day today. You know, popular averages, we're looking kind of mixed here. What do you make of the action you're seeing?
Look, struggling to find direction. I mean, it's poetic justice that we're starting off September with a little bit of a swoon here. Favorable decision going in big tech's favor in Alphabet's case, but I don't know that that's enough to carry.
I meant to ask you, because you have some big moves in big tech names, Google and Apple. I want to get your take on those moves, and whether just generally you're still a fan of the Mag 7 here.
I'm still a fan of individual players in the Mag 7. Not a fan of Tesla. I think Nvidia is a little bit stretched.
You're not buying an ETF, is what you're saying.
No, I'm not buying an ETF. Alphabet, I've been very bullish on that all the way back to April. I didn't think this regulatory risk was going to come to fruition. I thought it would be, but it was overdone. So that's played out. But I just don't know that this is enough to pull the big tech sector up over the course of the next month. We're in what I'd call the great in-between Nvidia's earnings and the next normal calendar quarter earnings report, which puts a lot of focus on now the Fed, what's going to happen. So in terms of portfolio moves, I'm making adjustments towards a value bias. So if you look at healthcare, the energy sector, the two most undervalued sectors in the S&P 500 right now. Jared brought it up in the intro. There's a weird dichotomy existing right now where the gold commodities to oil ratio is not normal, right? Gold to oil is at about a 50 times ratio. That typically happens when we're on the brink of a recession, but you saw it, the Fed's beige book today, no indication of an imminent recession. So that means that commodities and oil most likely are undervalued, and we need to see a resurgence there. So that's what I'm looking to position. You could do it via ETFs. The XLE, I think, has been trying to break out since August, just keeps getting swatted back down on oil price moves.
You mentioned the Fed. The market thinks that cut's coming. That's a lock. But we just spoke to Dennis Lockhart, who was saying, listen, he thinks actually the debate among the policymakers may be a little tighter than investors think. What do you think?
I think it's still up in the air, but the data that keeps coming in is making it more of a lock. So we've said it before too. The labor market is something that cools gradually and then suddenly, and we're starting to see those indications now. The longer this tariff uncertainty exists, the more likely it is that companies are going to hold off on hiring. The labor market's going to cool because they just don't know what to expect. So I think by the time we come around to that meeting in a couple weeks, we're going to have a few more data points that make it a lock. I mean, Fed Market Watch tool now is saying it's 4% chance that we don't get a cut. A month ago it was at 20%. So I think the market has adjusted, expected it. Would be surprised if we don't get one.
Let me ask you this. What is more important to the market, in your opinion? Is it the Fed, or is it what we were just talking about, the great AI trade and trend?
I think they're equal, right? Because I mean, look what we're seeing in the bond market on fears of the tariffs having to be, refunded, is that it brings back into the forefront the deficit spending going on in the U.S. We have to start getting that under control. The economy needs to be resilient. We need the labor market to be part of that. So I think it's a balancing act. The AI trade is not enough to overcome the government spending.
Now that's interesting, because I have heard other folks make an argument. I'll put to you. They say, keep it simple, don't overthink it. As long as the great AI trade trend is intact, and if you were listening to that last earnings season, I mean, a lot of investing, a lot of spending. As long as that's intact, you just stay long the market.
Yeah, but this is like...
Is that too simple?
It's too simple because look at Gartner's hype cycle that talks about the adoption curve of new technologies. What always happens is we overestimate the impact in the short term and underestimate it in the long term. I think people are overestimating how much power AI has. And look, I'm a big bull on this, but we can't just ignore everything else because AI is such a strong growth trend. If we look at like the last 2 quarters of GDP growth, the two-quarter moving average shows consumer spending and AI CapEx equal. So it's driving the economy, no doubt. But does it have enough escape velocity to get out of the way of the rest of the week?
Of sort of housing, labor market, state and local government contraction.
Housing, I think, is the key, right? I mean, you're looking at a lot of people that are rescinding their offers on homes, need an interest rate cut. Affordability is the issue. Does one interest rate cut become a silver bullet for housing? Absolutely not. I mean, the median home price is now at like $420,000. That's 150% above the median income, right? So we have an affordability and supply issue that's at the heart, but that hits home with everyone in America. The housing market. We've got to fix that in some way.
For sure. Lou, thank you. You're not going anywhere, of course. Have you for the rest of the hour. Stick with us. We are just getting started on market domination. Coming up, Alphabet hitting a record high after dodging a Chrome browser sale. But what will this mean for future tech and innovation? We'll explain. Plus, Eric Trump's wealth soars on $600 million American Bitcoin stake. We're going to tell you what you need to know about that crypto company. And Adidas gets a pep in its step on a new upgrade. All of those stories and a whole lot more coming up. Stick with us. Shares of Alphabet rising after a federal district court judge ruled late Tuesday that Google would not be forced to sell its Chrome browser after ruling divestment a, quote, poor fit in a landmark antitrust case. And joining us now is Bill Bayer, former Assistant Attorney General of the Antitrust Division at the DOJ and former Director of the Bureau of Competition at the FTC. Bill, it is great to see you, and you are just the man to talk to, Bill, and help us understand this. So Google, listen, bottom line, it avoids a breakup, Bill. Not forced to sell off Chrome, not required to divest Android. Investors cheer this decision, Bill. I saw analysts saying today this was the best case scenario for Google, but I'm interested, Bill, to get your response and your reaction. Do you believe this was the best remedy for this case?
It was a cautious remedy from a really smart, careful, thoughtful judge. I think his decision not to order a breakup is probably defensible. But whether he did enough to do what his job was, which is to restore a competition that was lost because Google got itself to a 90% market share of search without by eliminating its competitors, by restricting competition. Is this remedy, the question is, enough to allow for competitive search going forward? That's the fundamental question.
Bill, I also want to ask you a question that has been raised, and I'm interested to get your thoughts about this, is whether the government with this case, taking on Google here, was just kind of fighting last year's story. The idea being that search, Google's bread and butter, it is fundamentally changing. That Gen AI models are importantly and dramatically affecting this market, affecting this industry. I thought it was interesting the judge did right here. The emergence of Gen AI changed the course of this case. I mean, was Bill, in your opinion, the government just waging kind of an old battle here?
I don't think it was waging an old battle, but the judge is right to say, but we got to be both looking at the bad conduct that got Google unlawfully to its 90% share, but figure out what's going to happen going forward given AI. Now, the judge decided that he wanted to err on the side of caution because we can't predict. He said, I don't have a crystal ball. I can't tell you what's going to happen with AI. But one concern here is that Google, by having its own AI product and having its relationships with the hardware manufacturers and others, may be in a position to extend its dominance in search into making its artificial intelligence tool the predominant tool there. And that's where I think critics are legitimately concerned about whether this remedy is too cautious.
Well, I meant to ask you, but listen, put your old hat on. If you had been trying this case, Bill, if you'd been prosecuting this on behalf of Uncle Sam, I'm just curious how you would be feeling today. Would you be feeling like, yes, this was a good use of my time and energy and focus, or would you be feeling disappointed?
Probably a little bit of both. There is no doubt in my mind that this was a worthy case to bring. Would I feel somewhat shorted in terms of the remedy, given how strong the Judge Mehta, found that there was anti-competitive monopolization behavior that helped elevate Google to its 90% market share? Yeah, and the Justice Department, Gail Slater, the head of the Antitrust Division, has said they're going to look carefully at whether or not to contest these remedies on appeal. There are meaningful remedies in here. Sharing a lot of its user data, sharing its ad tech availabilities with competitors, potentially gives some ability to other search engines to get a foothold in this market that they've been denied up until now. So it's really, from the point of view of the Justice Department, it's a worthy case to bring. Bad behavior always needs to be prosecuted. The question is whether the remedy is going to adequately protect against bad behavior in the future and adequately remedy the bad behavior that brought about the case in the first place.
It's interesting, Bill, just more broadly. It seems like the U.S. government has, Bill, and I'm interested to get your thoughts on this, has a tough time with this effort to rein in big tech. I mean, whether it is DOJ or FTC, and whether, Bill, it's Democratic or Republican administrations, it seems like they've had a rough time with this effort. I mean, I just think of Microsoft and Activision, or HPE and Juniper, but I'm curious to get your take.
Well, these cases, the challenges, they take such a long time, and a well-funded defendant will pursue lawfully. There's some question about whether Google withheld data it should have turned over, but pursue its legal rights. But that means behavior that the judge found have been going on for about 2 decades has yet to be remedied. And there will be an appeal here. I'm quite confident Google will appeal, not so much because it objects to the remedy, but it probably would prefer not to have it at all, but because it objects to the finding that it behaved unlawfully, that it became a monopolist through bad behavior. These cases are worth bringing. They actually do. I was in private practice as well as in the government. Companies think twice about behaving if they're going to be put through a major litigation that'll cost them a lot. And so they may behave more differently. This is the notion of general deterrence as opposed to specifically deterring Google from what it did in the past.
I'll get you out of here on this, Bill, with a question I've seen being asked. I'm curious to get your answer. The question being, will other judges now, Bill, involved in other big tech cases, Amazon, Meta, Apple, do those judges, Bill, now use this case, this ruling, as a blueprint there? Could we expect more good news for big tech?
Well, the facts differ so much, and this opinion is not binding on any other court because, as I said at the outset, thoughtful judge, careful judge, that opinion is going to be closely read. It will probably put many lawyers and many judges to sleep, given its length. But over the course of 3 nights reading, it's helpful to think through how you behave as a judge when you find unlawful monopolization behavior, and then figure out what the hell to do in order to remedy it.
Bill, thank you so much for your time today and your insight.
Thank you.
Now time for some of today's trending tickers. Prairie Operating Company's Lou Basenese joins me here with a look now at American Bitcoin, Adidas, and Wynn Resorts. First up, American Bitcoin, the Trump-backed Bitcoin company making its debut, Lou, on the NASDAQ. Eric Trump, a shareholder of American Bitcoin, noting that the company's debut marks a historic milestone in bringing Bitcoin into the core of U.S. capital markets. We were talking about this one off camera. All right, so it starts trading on the NASDAQ. Let's get to the headline here. So the company plans to accumulate Bitcoin, from what I understand, Lou, just so people understand, using machinery in New York, Alberta, Texas, provided by another crypto company. Okay, but here's your headline. Bloomberg noting Eric Trump's stake in this company, according to Bloomberg, now worth more than $600 million. In fact, they say, Lou, let's put a bullet point on this. That stake is worth more than the value of a collection of 13 different golf and resort properties in the U.S., Scotland, and Ireland. Good work, if you can get it.
Good to be the president's son,
Yes.
whatever administration, right? Here's what I think is interesting. Historic milestone. There's been, up until a couple weeks ago, 92 corporate, crypto treasury strategy companies that have been launched. Over 30 of them in the Bitcoin space. So this isn't novel. I think what really is essential here is differentiation, right? So I think in this instance, they did spin out some Bitcoin mining operations at a Hut 8. So that gives them some differentiation. but you're seeing the whole space. The more and more capital that comes in to just buy and hoard crypto, the more these companies are going to trade closer to a MNAV of 1, and we're seeing that play out. So it's not novel. I think you're going to see a lot more of it. It's one heck of a payday if it lasts. I mean, we don't know what the lockup restrictions are.
Right.
But I would say it's indicative of a trend that is continuing to unfold. I sit on a few boards. What I've seen from my vantage point is there is an unlimited appetite for crypto treasury strategies coming from institutions, and the Trumps are behind that in some of their plays here too.
What a headline. All right, moving on. Adidas getting a lift at Jefferies from hold to buy, from highlighting the company's valuation. So this one, Lou, so Jeffrey upgrades this one to buy. They're believers. They say, listen, sits at a historically low valuation trough on all relative measures. They talk about expecting guidance upgrade in October. They note well-run brand. JP Morgan also, by the way, places this one on a positive catalyst watch, disciplined product portfolio management, and cost control. What do you think?
Yeah, I question the conviction here because Jefferies upgraded it from a hold to a buy, but then they dropped the price target. So I think there's still some demonstration in the fundamentals that have to prove out this point.
You're questioning if they're all in.
I don't know that they're all in, but I think they're on the right track, the right trajectory here, because Adidas has got a lot of potential tailwinds coming from the World Cup and apparel related to that. We've seen this with Netflix. Live sports, sporting events are driving a lot of consumer-related brands. I think that's going to play out well here for Adidas.
All right, final one I want your take on. Wynn Resorts getting a lift at Argus, the firm upgrading that stock from hold to buy, saying looks like the prospects for market share gains and the company's leadership position in the Las Vegas market, Lou, they say for casino resorts, cause for optimism. They talk about a significant recovery in Macau. They're looking for rapid growth at a property in the UAE, target 145. What do you think?
Yeah, Macau revenues, I'm not a believer yet because Macau revenues are up 12% in August. That's a clear recovery. But
stock is up nearly 50% this year.
65% in the last year. If you look at all the other data coming out from Las Vegas, right, you're talking about it being too expensive for the average American. You're seeing hotel bookings down. So there's a disconnect here yet that hasn't played out for me. Typically, casino stocks, gambling stocks, and Sotheby's, when it used to be traded, publicly traded, were an indicator of getting too frothy, right? Because it's a sign of conspicuous consumption if these businesses are booming and signs that we're getting closer to a top. So I'd monitor this of if Wynn continues on this tear, are we really getting near the peak economic growth, peak consumer spending, and in turn getting ready for a pullback?
You sound like a neutral to me on Wynn.
I am. I'm not a gambler by trade. Why gamble? I would rather invest in stocks that you're at least buying a business.
Fair enough. Wise advice. Coming up, cybersecurity firm Zscaler announcing an earnings beat, topping Wall Street expectations. We're speaking live with its CEO on what's next for that company. It's an interview you don't want to miss. Stick with us. Zscaler delivering a Q4 beat with revenue up. Demand for the company's zero trust and AI-powered security offerings playing a big role. Joining us now, we have CEO Jay Chaudhry with more on the results and Zscaler's performance. Jay, always great to see you. So analysts weighing in on the quarter, Jay, they say Q4 results brought a strong end to the year. They say strong outperformance. They talk about operating margins reaching a record level. Walk us through the report, Jay. What are you seeing in the business?
Josh, good to be back on your show. It was an exciting quarter. To cross $3 billion in ARR is a big milestone. The only two pure play SaaS security companies have done it. It's wonderful to be in that league. Our results, our ARR grew 22% year over year. Our billings are over 30%. Free cash flow, 27%. We beat all the numbers. We exceeded all the numbers market was looking for. So very happy with what we have done, and it's driven by delivering great solutions to our customers.
I did see analysts bring up, Jay, I want to get your take on this. They note that initial organic guidance for 2026, they note, did come in slightly, they say, light of expectations. What color can you offer investors there?
Look, we are always prudent about giving guidance. Our goal is to beat our guidance and deliver good results. We have a track record quarter after quarter, beating the guidance and delivering good numbers. If you read most of the reports, they'll tell us that the guidance is good, numbers are great, ARR is a great metrics, and more exciting for me is the large enterprises who are buying more and more of Zscaler solutions. It used to be securing users. Now they want to secure their cloud workloads, AI models. They want to secure the branches. They want to secure IoT, OT device in the plants. So we are becoming the platform of choice to eliminate legacy firewalls, VPNs, and all those point products. And we don't only offer better security, we reduce cost and give business agility so you can open new warehouse, a new office sooner than it would take otherwise.
Jay, I want to broaden the discussion out, talk about the macro, the economy, because there is concern in some quarters, Jay, about the economy, a slowdown. What are you hearing from customers, Jay? Are you seeing, Jay, any evidence of that in your business?
Economy has been tight for quite some time. There is a scrutiny on larger deals. But if you are doing critical cybersecurity, like zero trust security, and you can save cost, you can get your deals done. There is some uncertainty about the tariffs issues. But when I talk to CIOs, when I talk to CISOs, number one thing on their mind is, I can't have my business getting impacted with the ransomware attacks. AI is making it easier and easier to do those attacks. So we aren't seeing any slowdown from demand point of view. We aren't seeing any slowdown from our solution expansion point of view because we are saving money and giving better security. That's why our numbers are so good. That's why we are expecting a good fiscal 26 as well.
Let's talk about the competition, Jay, because you're dealing with Palo Alto. Netscope recently filed its S1. How do you see the competitive landscape, Jay, shifting and evolving?
It's a good question. Since we started Zscaler, lots of competitors have come and gone. They used to be secure web gateway. They used to be these remote access VPN companies. Now firewall companies trying to come around. The CASB companies are trying to come around. I think to do the right security, which is zero trust architecture based, you need to build it from a clean slate. You can't take firewalls and spin them in the cloud and say, I got zero trust architecture. So while there's a lot of noise from a bunch of legacy security companies, when we engage with customers and explain to them that zero trust architecture is different than firewalls, we almost always win. Some of the young companies trying to come from behind and trying to compete in this market, it's very hard for them because customers do not want point products from young companies. They want platform. In addition to that, the service we provide is mission critical because all traffic goes through us. We are the switchboard. In fact, some customers have told me, Jay, Zscaler is more important for me than even Microsoft Office 365 because we make every connection work. And our customers are uncomfortable in working with small point product companies to put this mission critical applications on them. That's why they select Zscaler because we have a proven experience with over 45% of Fortune 500 companies who depend upon us.
Jay, what about agentic AI? I'm curious how you see that technology impacting your company both now and ahead, Jay.
Oh, agentic AI is going to have big impact. It already having some, but from security point of view, there's some much bigger opportunities. Today, agentic AI is being used by bad guys to identify attack surface, to automate things, to really find applications and attack them. What has Zscaler done with it? First, we helped our customers to make sure your data doesn't leak to ChatGPT or Gemini of the world. Two, if you're building your private models, we help you secure those models. Number three, there will be lots and lots of agents. These agents will talk to applications. Agents need to talk to other agents. How do you ensure that right agent is talking to right agent? We are zero trust exchange for users, then for cloud, then for branches. We are best positioned to make sure we become the exchange for agent-to-agent secure communication. An area of focus for us, we are counting on it as a big opportunity for us.
Jay, finally, I'm always interested to get your take on just the general threat landscape, Jay, what you're seeing, what you're hearing. I've spoken to analysts who say, actually, it seems, relatively pretty quiet right now. And maybe, frankly, they say, we're just growing more immune to it. But what do you think?
These days, bad guys don't make a lot of noise. They basically go in your infrastructure, they hide there, and they want to take an action at the right time. There are a few different kind of actors. There are actors who want to make money. They quietly go in, they ask for ransomware. If you see our Threat Labs report, the ransomware attacks aren't slowing down. The numbers may go down, but the quality of attacks is going up. On the other side, when you see nation states do not want your money. They want to control your infrastructure so they can take control at the right time. I think our country could do a lot more to do better security of infrastructure, what we call critical infrastructure, our logistics, our telecommunication, and the like. And we are working with many government organizations, many of our agencies, to help them, because for me, Zscaler is not just business. National security is a part of it, and we are proud to be working with our federal government in this area.
Jay, great seeing you. Always great to have you on the show. Thank you.
Josh, thank you.
Coming up, NVIDIA's story is evolving as the stock seesaws, taking a look at what may be in store and what the moves mean for the market and your portfolio. That story's coming up. Stick with us. Shares of NVIDIA seesawing, climbing back after the August pullback, only to fall again to start September. Our next guest, watching how this bounce progresses, which will be key for whatever new highs are on the horizon for NVIDIA. For more, I want to bring in now Mark Newton, Managing Director and Global Head of Technical Strategy at Fundstrat Global Advisors. Mark, always great to see you, especially on set. So I want your take on a number of names, but let's start with NVIDIA, because they did report. I heard from a number of analysts, but I want your take. What do the charts tell you about Jensen Huang's company?
Well, look, the stock has been up about 113% in 17 weeks. And so, it's had a period of consolidation over the last 4 weeks. I don't think that necessarily turns trends bearish, so to speak. But in general, it's worth paying attention to whenever momentum starts to slow on a stock that's had a big run. I think it's range bound, really, between like $165 and $184. And so I think it's sort of a choppy, sideways pattern. It doesn't really make me want to sell the stock, and I think potentially it has maximum downside. If it were to break 167, you might get down to 161, but still extraordinarily, a big outperformer versus most of its peers, and so the company still seems to be hitting all the metrics from a fundamental perspective as well, and I'll defer to others on that, but I think that it's still right to own the stock, even if we do see some minor backing and filling after this big run-up.
And Lou, you own NVIDIA, correct?
Yeah, I do. I was late to the party, but I'm still at the party nonetheless. But I would agree with you. From a fundamental perspective, there's not a compelling reason to just buy a ton more here right now. But I do think you have to own it. It's 8% of the S&P 500. You have to have a position in it. It's something to watch for the momentum. The fundamentals, people have just gotten spoiled. The growth has been so good and off the charts that they want even more. But I think right here it's still a compelling stock to own in this market. Yeah,
look, seasonally it's a tough time of the year, right? And so you've seen a little bit of pullback in many of the leading names, particularly within the software space. And so semis and software, tech has been a little bit of bifurcation. We can speak about that a little more, but it's right to be patient in September, October.
What kind of bifurcation are you seeing?
Well, one of the biggest underperformers in the last month of all the level 2 groups in the S&P has been software, whereas the biggest outperformer has actually been tech hardware. So we have stocks like Apple and Dell, which are up over 10%, HP, Seagate, whereas many of the software names have been really hard hit, and so trying to struggle to keep up with the whole AI theme and maybe getting caught behind the curve, who knows. But it's right to at least acknowledge that technology being 30% of the S&P has outperformed pretty sharply in the last month, and that is a key part of the market. Thankfully, other sectors have stepped in to pick up the slack, financials, materials, discretionary. That's a good sign. If those were to start to stall out and roll over with tech not performing well, then we probably would see some weakness. And I think that probably is possible in September, October, but I'm encouraged by the degree of breadth recovery we've seen in August. I think that we have a dovish Fed. Earnings season has been great. We have fundamentals that are arguably still intact, even maybe a little weakness on the fringes. But I think, it's still an environment right now where investors are largely still on the sidelines. I'm seeing that on both the retail level as well as the institutional level. CFTC positioning suggests that investors are readying for a pullback. For me, that doesn't make me want to get real bearish when trends really haven't been broken. So trends are fine. I think the economy is sort of in a sweet spot where you have everybody sort of wondering what the Fed's going to do and how many cuts are built into the curve. And meanwhile, the economy is not necessarily falling off a cliff. So 4 cuts between now and next summer, and trends are intact, and earnings growth is great, and the Fed is dovish. I mean, sign me up. I'll be a buyer of any dip.
Well, one data point I always gravitate towards is the $7 trillion in money market funds right now that are earning $500 billion in annual dividends. So that's even more dry powder once the consumer comes in and says, hey, we can put more to work in the market.
Yeah, and I think a lot of people dug in their heels early on and now are being forced to chase the rally. And so it's understandable. Look, it's a chaotic time and a lot of, interesting to see how things shake out with a degree to tariffs, but it's really been never anything that investors should pay close attention to because it hasn't affected the market thus far. Inflation has not really reared its ugly head. We have many factors that are offsetting that. Crude has been plummeting of late. It's still going to go down further. That's a big factor, and also just the deflationary effects of AI, I think, are also going to offset a lot of that temporary increase in inflation. For those that do think there's inflation, what do you say about wage growth plummeting? That's a necessary ingredient, to say, oh, there's big inflation coming. So you might have a little bit of a bump into year end, but I don't think we're going to get anywhere near where we were.
Let me ask you, we've been talking stocks, Mark, but while we have you, I want to talk metals with you as well, particularly gold. Yeah. What do you make of the movement we're seeing there? Well,
it's a wonderful breakout. Look, technically, everybody can see that gold has been in a 4.5 to 5 month range-bound period and just broke out above 3,500 the other day. So we're in a very nice environment for precious metals. We have real rates that are dropping like a stone. You have the Fed set to cut. We have about an 88% chance of the Fed cutting in a few weeks. And people are concerned about the fiscal situation, not only here but abroad, and I think that that's a great environment to invest in precious metals. It's less about inflation. I think it's more about just something that works well. It's always been difficult to say this is the fundamental reason why gold is working, right? But I mean, silver is actually working better than gold as an industrial metal, and so I like the precious metals, particularly those that are a little bit too top heavy in technology, as a source of diversification. It's great to be in the metals at a time when the market's slowed a little bit in the last month. I mean, the market is at the same level it was in mid-July. So despite being up, 33% in 20 weeks on the S&P, there is some evidence now of reaching the fall period, seasonally weak. It's right to be in the metals. It's seasonally a very bullish time for gold and silver.
Mark, always great to see you.
Thank you very much.
Thank you, sir.
My pleasure.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.